A warm welcome to all viewers tuned into this broadcast, Market Perspective. Today, I'm conducting an interview with Dr. Joseph Thomas, Head Research, Emkay Wealth Management, discussing topics on current economic affairs. Dr. Joseph, welcome to the show.
Thank you very much.
Let us first have a quick glance at the recent interim budget. What do you think are the 2 or 3 special features which are of consequence to the economy and market?
The interim budget provides a significant amount of stability and continuity as far as economic policy is concerned. That's probably the greatest achievement of this interim budget. There are 3 things which stand out in the interim budget which are of benefit to the economy and the markets. The first is that the government borrowing program is much lower for the coming financial year compared to the current financial year, and that would mean that the government will go to the market to borrow much less amount, both on gross basis and on net basis. It would make available more resources for the private sector to access the markets and mobilize resources for their business requirements. A second thing is that there is greater clarity on the fiscal glide path. We are moving from a fiscal deficit of 5.8 to around 5.10 in the coming year, and probably move towards 4.5% after a couple of years from today. A third factor which is of consequence to the markets and the economy is that the government capital expenditure, which was provisioned at around 10 lakh crores in the last full-fledged union budget. In the interim budget, it's put at around 11.10 lakh crores. So therefore, the requirements of a public capex to help crowd in private capex is also taken care of. These are the 3 important features that stand out as far as the interim budget is concerned.
Sure. The US economic growth is still robust based on the recent data. How do you expect the Fed policy to evolve from here?
Yeah, the Fed policy is almost always linked to inflation performance, and the Fed's long-term target for inflation, consumer price inflation, is 2%. But the US inflation numbers, going by the CPI numbers, is currently at around 3.40%, around 3.5%, which means that the inflation performance needs to improve by about 140 basis points over the next few months before the Fed policy could effectively undergo a change. In our view, the US economic growth is quite robust. The last GDP number for the last quarter, which was announced, was at 3.4%, as against market estimates of around 2%. So the economy is growing at a robust rate. If you look at the manufacturing PMI, if you look at the last PMI, manufacturing PMI, the PMI jumped from around 47.80 to around 50.30 level, which means manufacturing is doing quite well. And these are factors which point towards robust economy and also an expanding economy, but at a slower pace. Therefore, we believe that the Fed may not go into a rate cut at this point of time. In the last policy, Fed had kept the Fed funds rate in the range of 5.25 to 5.5%. They are on hold. We believe that in the second quarter of this the current year, Fed could go in for the first rate cut. That the economy is expanding but at a slower pace is no deterrent to a rate cut. But they need to see that the gains made in inflation are sustained and that it in a sustainable way, inflation numbers gradually move down. That's what Fed would look at. Therefore, we expect the Fed rate cut to come in maybe at earliest in the second quarter of this calendar year.
Dr. Joseph, what's your view on domestic interest rates? What is the portfolio positioning that you would suggest on the fixed income part?
Yeah. As far as domestic interest rates go, we have slightly elevated rates at the short end of the curve or in the short-term money market, and we have much lower rates at the long end of the curve, which means the long end rates have moved down a little bit and the shorter end rates have moved up. Now, what is it that's now going to affect the interest rates? One of the things is that the official interest rate policy of the Reserve Bank of India. The Reserve Bank is currently on hold, like the Federal Reserve Bank of New York. We expect RBI to go in for the first rate cut, probably in the first quarter of the next financial year, may not be earlier than that. There could be two reasons why RBI could target an interest rate cut sometime around the first quarter of the next financial year. The first thing is that there has been some impact of inflation on rural consumption, and we need to bring that back for the economy to grow at a good pace. Second is that we would also see the elections coming up.
Okay.
This election season, and also the summer season coming up. So keeping these factors in mind and to maybe promote rural consumption and also to promote investments further, RBI may need to bring down interest rates gradually, and the first rate cut we could expect in the first quarter of the next financial year. As far as inflation performance is concerned, in India we have much lower core inflation at this point of time. It's sub 4%. Whereas the headline inflation is still at 5 plus. This headline inflation at 5% or above 5% is mainly because of the prices of fruits and vegetables, and mainly in the fruits and vegetables basket because of tomatoes and onions, which we know that it's quite seasonal. It moves up, sometimes it comes down. So if we eliminate that, the only factor which could influence the inflation performance is fuel or the oil prices. Our view is that the oil prices are very well contained at this point of time because of two factors. There is a significant amount of demand destruction that has happened in the US and Europe because of the high oil prices or fuel prices. A second factor is that the US oil production is at its record high levels of 30 million barrels per day. And it looks like even without the OPEC, the world may be able to manage its energy requirements. That is where things are coming to be, and all those things will keep oil prices under pressure, and we expect the range to be around $78 to maybe $85 per barrel as far as Brent is concerned. And those things may not exert too much of an inflationary pressure as far as domestic price level is concerned. So as far as RBI policy is concerned, it's going to be softer as we move into the next first quarter of the next financial year. Liquidity conditions are okay. RBI is managing it better, and inflationary pressures may not be too much in the coming days. These factors warrant a reduction or a fall in interest rates. We are seeing it at the long end because it gets reflected at the long end at this point of time, because long end had not moved for a long time. At the short end, there are some liquidity pressures because of which rates are slightly elevated, but overall rates will start moving down.
Thank you. The money market liquidity is tight. How do you expect the situation to progress from here on?
The money market liquidity has been tight, and RBI has been managing it very well, mainly by supplying the essential liquidity to the markets. RBI has been supplying liquidity to the markets and has been managing it very well. Quite like the Bank of England and like the Bank of Japan, RBI is managing the liquidity, the short-term money market liquidity extremely well. Now, we need to, if on a continuous basis, there is a sustained shortage in money market liquidity, RBI will have to supply that on a rather permanent basis. We expect the RBI to move on to supplying that liquidity, at least a part of the long-term liquidity requirements, on a sustainable basis very soon, maybe over the next couple of months or before the April financial year beginning. RBI could start loosening the liquidity a little bit, but RBI would like to see inflation come down in a sustainable manner. Second is that RBI wouldn't like to leave any excess liquidity in the system, because any excess liquidity in the system, in the interbank market, could lead to asset price inflation. It means that money could go into equities, money could move into real estate. So RBI would not like the asset price inflation to come up and aggravate when already there is a consumer price inflation also, which the RBI is fighting. So we expect the money market liquidity conditions to improve, and most likely RBI could supply at least a part of the shortage which is there on a perennial basis at this point of time, which we have witnessed in the last 2 or 3 months.
So we have this significant bond index inclusion. You think it's going to help the fixed income markets? How do you visualize the situation from here on?
Yeah. One point which I missed from your last question was the investment preference as far as fixed income is concerned. We recommend gilt funds at this point of time. We had put out our first recommendation on gilt funds on 6th of November 2023, when the 10-year was trading at around 735, 740 levels. It has actually come down to around 705, 710 levels at this point of time. We expect those 10-year benchmark yields to progressively move down towards the 680, 690 levels. And also maybe even still lower as RBI starts the interest rate cut, the official interest rate cut over the next 1 or 2 months' time. So gilt funds is a preferred avenue as far as fixed income investors are concerned, and we recommend that. That is a strong investment preference as far as debt market is concerned. As far as the bond index inclusion is concerned, because we are going to be progressively included in the JP Morgan emerging market bond index, it is likely that the Government of India bonds will be included in the Standard Chartered bond index and also in the Bloomberg Global Bond Index, which means that there is already a quantum of funds, an amount of funds, trillions of dollars tracking these bond indexes. They invest according to this index. Say, for example, as far as JP Morgan index is concerned, there is approximately 250 billion US dollars worth of funds which invest tracking the JP Morgan emerging market bond index. When India comes in and takes up a share of 10% of the bond index, 10% of the funds would get invested into India, which means we'll get about 25 to 30 billion US dollars into the government bond market in India. Same thing is likely to happen when we are included in the Standard Chartered bond index as also the Bloomberg bond index. And it's a happy thing to see that in the last 3 months, we have received 7.5 billion US dollars into the government bonds, into the bond markets, which is, earlier we used to receive some small monies, very sporadic, intermittent investments by FPIs. Now it's a larger amount, $7.5 billion in the last 2 or 3 months is not a small amount. I think that will also add more liquidity to the local bond markets, and it will also help in further decline in the yields of mainly benchmark securities, whether it's the 10-year, the 7-year, or the 5-year. We'll see the yields declining. And this is a very good opportunity for domestic investors also to invest into the markets and gain from a sustained fall in the market yields, especially in the mid and long dated securities.
Coming to equities, what are the 3 key factors supporting the markets?
The most important 3 factors I would like to enumerate. The first is the GDP growth. The last GDP growth number we had was 7.44% for the last quarter. Then India is destined to grow or India is tuned structurally to grow at around 7%.
Okay.
That is, so we, come what may, we'll be growing at around 7%. That's the rate of GDP growth that we could expect. Maybe 0.5% higher or 0.5% lower may also be there. But this GDP growth is something that's going to be a very important facilitator for the corporate performance, because GDP growth reflects, it's positively correlated to corporate earnings growth is positively correlated to GDP growth. The performance of the financial markets is then linked to the corporate performance. So GDP growth is the first and foremost factor. A second factor which could help the local markets to do well is the public capex, which has supported the economy in the last couple of years. It is likely to support further as we go by the numbers of the interim budget that we have with us. And we also need to see RBI cutting interest rates as soon as possible, at least as we move into the first quarter of the next financial year. We need to see RBI bringing down the interest rates, because then credit becomes less expensive or cheaper, and that will also help business and industry. These are the three factors which are of prime importance. We also need to look at a further revival of rural demand, which I mentioned a little earlier, that the rural demand is a bit subdued, mainly because of inflation. So we need to see the rural demand also coming back to normal levels. These are the 2 or 3 factors which are at the core of equity market performance as far as India is concerned. From the liquidity perspective, as we had mentioned earlier also in our publications and notes, that the liquidity dynamics for the local market has completely changed. We get about $2.5 billion worth of rupee investments locally into our equity markets on a continuous basis through the systematic investment plans or SIPs. Therefore, even if there is some outflow from FIIs, that's not going to affect the markets much. So that liquidity dynamics having changed would also support the markets. These are some of the positives for the local equity markets at this point of time, and for the coming, at least coming 6 months to 1 year.
Joseph, sir, I would like to ask a concluding question. What are the investment preferences at this juncture?
As far as equity investment preferences go, I think those who are wanting to or looking at good growth in the portfolios, they could look at good mid-cap funds to invest into, where the valuation is quite reasonable. And we believe that with interest rates coming down and rural demand picking up, GDP growth because of the structural tuning of growth at around 7%, and a lot of liquidity moving into these stocks, both from overseas investors and domestic investors. Mid-caps should be looked at as a very good investment avenue and should be made a part of the portfolios. Some amount of investments could go into large caps also, but that would be an avenue where you might get maybe an index plus performance, but it would be close to the index performance. And small caps at this juncture are a bit expensive. Going by the long-term PE multiples, they look slightly expensive. Therefore, one could, if at all one is looking to invest into small caps, one could look at investments in a graduated way, or as and when we get some amount of correction by which the valuations become slightly more attractive. Therefore, the first preference would be the mid-cap segment, followed by a little bit of large caps and then the small caps. That would be the structure, that would be the order in which you may be looking at it. And I would very strongly suggest investors to look at very well managed products which have a very good track record. That is very, very important, and a sustained and consistent delivery of returns. is what's important when it comes to managed funds and managed portfolios, both from mutual funds and from PMS. So you could look at one could look at good managed funds from mutual funds, PMS. There are good alternate investment funds also, but which have a very good track record of delivering performance consistently over longer time periods is something that investors should look at.
Thank you, Joseph, sir.
Thank you very
Great
much.
insights from you.
Thank you.
Thank you, viewers, for joining us in today's interview. Have a good day.